My dear students, welcome back to our channel. In this video, I will be explaining the BBA 5th semester subject analysis of investment in financial assets as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3, first important short question is: explain systematic risk. Systematic risk is the type of risk that affects the entire market or whole economy, not just one company or one industry. It is also called market risk or non-diversifiable risk because it cannot be avoided by holding a diversified portfolio. Even if you invest in many different companies, this risk will still affect all investments. Systematic risk arises due to big economic events such as inflation in the country, changes in interest rates by RBI, recession or economic slowdown, political instability or elections, global events like war or pandemics. Example: if RBI increases interest rates, stock prices of all companies may fall. Even a strong company like TCS or Reliance cannot escape this market-wide impact. This fall in prices is due to systematic risk. Easy tip to remember: systematic is equal to system-wide risk. Affects everyone. Cannot be escaped. This risk is measured using beta in CAP for finding expected return. Next important short question is: 2. What is unsystematic risk? Unsystematic risk is the type of risk that affects only a particular company or a specific industry, not the whole market. It is also called company-specific risk or diversifiable risk because investors can reduce or eliminate it by holding a diversified portfolio. This risk arises from factors inside the company or within the industry, such as poor management decisions, labor strikes, product failure, change in company policies, sudden fall in sales, fire, theft, or internal fraud. Example: if a company like Vivo faces a workers' strike, its production may stop. This affects only Vivo, not other mobile companies like Samsung or Apple. Similarly, if Tata Motors suffers a fall in car sales, it does not affect IT companies like Infosys. This is unsystematic risk. Easy memory tip: unsystematic is equal to unique risk is equal to only one company industry. Can be diversified. By investing in many different companies, diversification, this risk becomes very low. Next important short question is: 3. CAP, Capital Asset Pricing Model. CAP is a model used to find the expected return of an investment by considering its risk. It tells investors how much return they should earn for taking extra risk compared to the risk-free return. The formula is: expected return is equal to risk-free rate plus beta, market return, risk-free rate. Here, risk-free rate is equal to return from safe investments like government bonds. Beta is equal to measure of systematic risk. Market return is equal to average return from the whole stock market. Meaning, CAP says that if a stock has higher beta, it is riskier, so investors must get higher returns. Example: risk-free rate is equal to 5%. Market return is equal to 12%. Beta of stock A is equal to 1.2. Expected return is equal to 5% plus 1.2, 12%, 5%. Is equal to 5% plus 1.2 by 7% is equal to 5% plus 8.4% equals 13.4%. This means investors expect 13.4% return from stock A. Easy tip to remember. More beta is equal to more risk is equal to more expected return. Next unit 3. Long questions. 1. What are the features of common stock? Features of common stock. Common stock, also called equity shares, represents ownership in a company. When a person buys common stock, he becomes a part owner of the company and enjoys certain rights and benefits. The following are the key features. 1. Ownership and voting rights. Common shareholders are the real owners of the company. They have the right to vote in general meetings and elect the board of directors. Example, a shareholder of Tata Motors can vote on decisions like approving dividends or appointing directors. 2. Residual claim on income. They receive dividends only after preference shareholders are paid. Dividend is not guaranteed. Example, if profits are low, the company may skip dividends. 3. Limited liability. Shareholders are responsible only up to the amount they invested. Their personal assets are not affected. Example, if a company shuts down, the shareholder can lose only the money invested in shares. 4. High return potential. Common stocks offer higher returns through dividends and capital gains. Share prices may rise substantially over time. Example, Infosys shares purchased at 200 rupee may rise to 1,500 rupees in a few years. 5. Marketability, easy to buy and sell. Common stocks can be easily traded on stock exchanges like BSE and NSE, offering high liquidity. 6. Risk of fluctuation. Share prices can rise or fall due to economic and company factors. This makes common stocks riskier than bonds. Example, during a recession, even strong companies' share prices may fall. 7. Right to information. Shareholders have the right to receive annual reports, financial statements, and updates about the company. 8. Residual claim on assets during liquidation. If a company closes down, common shareholders are paid last after all liabilities and preference shares. 9. Preemptive rights in some companies. Shareholders get the first right to buy new shares to maintain their proportion of ownership. Easy way to remember. Rights plus returns plus risks. Rights vote, information, ownership. Returns dividend and capital gain. Risks price fluctuation, last claim. Next important long question is 2. Approaches to valuation of common stock. Valuing common stock means finding the true or fair value of a share. Investors use this value to decide whether the share is overpriced, underpriced, or fairly priced. There are 3 major approaches to valuation. 1. Dividend discount model, DDM. This approach says that the value of a share is equal to present value of all future dividends a shareholder will receive. Formula. Value is equal to dividend, required return growth rate. Idea. If a company pays steady dividends, this model works best. Example. If a share pays a dividend of 5 rupees, growth rate is equal to 4%, required return is equal to 10%. Value is equal to 5, 0.10 to 0.04 is equal to 83 rupees and 33 paise. Easy tip, DDM is equal to dividend lovers model. 2. Earnings capitalization model. This method values a share on the basis of its earnings, EPS. It assumes that the company's earnings represent its ability to pay dividends in the future. Formula. Value is equal to EPS capitalization rate. Example. If EPS is equal to 10 rupees and capitalization rate is equal to 12%, value is equal to 10.0.12 is equal to 83 rupees and 33 paise. This model works when dividends are not regularly paid. Easy tip: earnings model is equal to profit power model. 3. Price earnings (PE) multiplier approach. This approach compares the share price with the company's earnings per share using the PE ratio. Formula: value is equal to EPS times PE ratio. Example: if EPS is equal to 8 rupees and PE ratio is equal to 15, value is equal to 8 times 15 is equal to 120 rupees. This model is widely used in stock markets because PE ratio shows market expectations. Easy tip: PE is equal to market mood model. Which approach is best? Use DDM when dividends are stable and predictable. Use earnings capitalization when the company reinvests profits and dividends are irregular. Use PE approach when comparing similar companies in the stock market. Easy memory trick. D. Dividends, DDM. E. Earnings, earnings model. P. Price ratio, PE model. DP is equal to 3 pillars of valuation. Next important long question is 3. Dividend discount model, DDM. The dividend discount model, DDM, is one of the most popular methods to value common stock. This model says the value of a share is equal to the present value of all future dividends the shareholder will receive. In simple words, if a company regularly pays dividends, then the price of its share mainly depends on how much dividend it will pay in the future and how fast those dividends will grow. One basic idea of DDM. The logic behind DDM is: investors buy shares to earn dividends. So, the value of a share is equal to expected dividends required rate of return. If dividends grow every year, we adjust the formula accordingly. 2 types of DDM. A. Zero growth model, no growth in dividends. Used when dividends remain constant every year. Formula: P is equal to DK, where D is equal to dividend, K is equal to required return. Example: dividend is equal to 5 rupees, required return is equal to 10%. P is equal to 50.10 is equal to 50 rupees. B. Constant growth model, Gordon growth model. Dividends grow at a constant rate, G, every year. Very useful for stable companies. Formula: P is equal to D, K, G, where D is equal to next year's dividend, K is equal to required return, G is equal to growth rate. Example: last dividend D is equal to 3 rupees. Growth rate G is equal to 5%. Required return K is equal to 12%. D is equal to 3 times 1.05 is equal to 3 rupees and 15 paise. P is equal to 3.15, 0.12 to 0.05 is equal to 3.15/0.07 is equal to 45 rupees. C. Multi-stage growth model. Used when dividends grow fast in early years, then slow later. This model is important for companies in the growth stage. Example: a company growing 15% for 3 years, then 5% forever. The value is calculated by finding the PV of high growth dividends and PV of stable growth dividends. Why DDM is important? Simple and powerful technique. Useful when companies pay regular dividends. Helps investors identify overvalued or undervalued stocks. Easy trick to remember. DDM is equal to dividend today plus dividend tomorrow plus dividend forever in present value. Next important long question is 4. Explain earnings capitalization models. Earnings capitalization model. The earnings capitalization model is a widely used method to value common stock based on the company's earnings, profits. This model is useful when a company does not pay regular dividends or when dividends do not reflect the true earning capacity of the firm. In simple words, value of a share is equal to present value of the company's expected earnings. Instead of dividends, this model uses EPS, earnings per share, to find the intrinsic value of a stock. 1. Basic formula. The model uses this formula. Value of share is equal to EPS capitalization rate, where EPS is equal to earnings per share. Capitalization rate is equal to required rate of return by investors. This shows that the stock value depends on how much the company earns and how much return investors expect. 2. Meaning of capitalization rate. It is the minimum return investors want from the share. Higher required return, lower value of share. Example, if investors expect a 15% return, the capitalization rate is 0.15. 3. Example. Let EPS is equal to 12 rupees. Capitalization rate is equal to 10%. Then, value is equal to 12/0.10 is equal to 120 rupees. This means investors should pay 120 rupees or less to earn a 10% return from this stock. 4. Adjusted earnings capitalization model. Some companies reinvest a part of their earnings to grow in the future. Here, the model uses value is equal to DPS kg, where DPS is equal to dividend per share, G is equal to growth rate of earnings, K is equal to required return. But this is similar to the dividend model and used when dividend depends on earnings. 5. When do we use this model? When dividends are irregular. When the company reinvests profits for growth. When you trust the company's earnings more than its dividend policy. Easy memory trick. EPS divided by K is equal to value. Or, profit power decides share value. Next important long question is 5. Price earnings multiplier approach. Price earnings multiplier approach. The price earnings multiplier approach, also called the P/E ratio method, is one of the most popular ways to value common stock. This method is widely used by investors, analysts, and the stock market because it is simple and reflects market expectations about a company's future growth. 1. Meaning of P/E ratio. The P/E ratio shows how much investors are willing to pay for 1 rupee of earnings of the company. Formula. P/E ratio is equal to market price per share earnings per share, EPS. If a company has a high P/E ratio, it means investors expect higher future growth. If a company has a low P/E ratio, it means growth expectations are low or risk is high. 2. Valuation formula. To find the intrinsic value of a share using this method. Value of share is equal to EPS times expected P/E ratio. This shows that value depends on two things. 1. Company's earnings, EPS. 2. Market's confidence, P/E ratio. 3. Example. Suppose EPS is equal to 10 rupees. Expected P/E ratio is equal to 14. Then, value of share is equal to 10 times 14 is equal to 140 rupees. This means investors should be willing to pay 140 rupees for the share based on earnings and market expectations. 4. Factors affecting P/E ratio. Several factors decide whether the P/E ratio will be high or low. A. Growth rate. Companies with high expected growth get high P/E. B. Risk. Low-risk companies, like FMCG companies, get higher P/E. C. Dividend policy. Regular dividend-paying companies earn better confidence. D. Market conditions. In a booming market, P/E ratios rise. E. Companies' brand image. Popular and trusted companies get premium valuation. 5. Why P/E method is important? Simple and fast. Easy to compare with similar companies. Widely used in the stock market. Helps investors judge whether a stock is overvalued or undervalued. Easy memory tip. EPS times P/E is equal to share value. Or earnings times market mood is equal to price. Next important problem is 6. The following information of a firm. I. Risk-free rate of return is 5%. 2. Market risk premium is 10%. 3. Beta of stock B of the firm is 1.4. 4. Standard deviation is 30%. What is the expected return of stock B according to the capital asset pricing model, CAP? Problem: expected return using CAP. We are given risk-free rate, RF, is equal to 5%. Market risk premium, RF, is equal to 10%. Beta of stock B, beta, is equal to 1.4. Standard deviation is equal to 30%, not needed for CAP calculation. We need to find expected return of stock B, RE, using the CAP formula. Step 1. Recall CAP formula. Expected return, RE, is equal to R_F plus beta times R_M_F, where RF is equal to risk-free rate. Beta is equal to beta of the stock, systematic risk measure. RF is equal to market risk premium. Step 2. Substitute values. RE is equal to 5% plus 1.4 times 10%. Step 3. Multiply beta and market risk premium. 1.4 times 10% is equal to 14%. Step 4. Add risk-free rate. RE is equal to 5% plus 14% is equal to 19%. Step 5. Conclusion. The expected return of stock B according to CAP is 19%. Easy way to remember. CAP is equal to risk-free rate plus beta times market premium. High beta, higher expected return. Low beta, lower expected return. Tip: standard deviation shows total risk, but CAP only considers systematic risk, beta.